Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, November 13th, and we'll see how things look for Friday, November 14th. The S&P experienced a sharp, broad-based decline on Thursday, the most convincing risk-off session we've seen in quite some time. The S&P 500 fell 1.66% on above-average volume, notably the first meaningful pickup in downside volume over the last number of trading sessions. This tells us that Thursday's selling carried conviction and likely included an element of panic or forced liquidation. Price action was equally unforgiving. The S&P 500 gapped lower at the open, broke below S2 at 6810, below 6800, and fell to S3 at 6770, and also declined down to S4 at 6729 before finding support and closing just above the S4 pivot point. In the process, the short-term trend has officially flipped to negative because the S&P is now below its 20-day moving averages. The intermediate-term trend remains positive for now, but the 50-period moving average cluster is converging across a number of different major indexes right now and is currently under a test. Key themes driving the move: the rotation out of growth into value and defensives has accelerated dramatically. Large cap growth dropped 2.19%, more than twice that of value. Small and mid cap growth to value ratios are breaking down, with the S&P and mid cap growth to value ratio now trading below its 200-day moving average. The discretionary versus staples ratio and high beta to low beta ratios have rolled over, a classic defensive positioning move. Fed rhetoric turned decidedly hawkish on Thursday. Governors Collins, Musalem, and Hammack all emphasized the need to keep policy restrictive longer to combat the sticky inflation currently residing at around 3%. Market-based odds for a December rate cut are currently at about a 50-50%, where just a week or so ago they were at 95%. Technical and sentiment gauges flashed multiple warnings. The VIX did go above 20 intraday but closed right at 20. And we have a confirmed Hindenburg omen that continues to be in play. And gamma exposure has now flipped negative. Breadth is deteriorating, new highs are contracting, new lows are expanding a bit, and the advanced decline line is rolling over. Sentiment surveys and put-to-call ratios show fear coming back into the market. Looking at the sectors, almost every sector was red except energy. Staples ended up closing flat. The heaviest damage was in tech, discretionary, and communication. Among the mega caps, Tesla was down 6.2%, Nvidia 3.6%, Amazon 2.7%, and Alphabet 2.8%. The Nasdaq 100, Russell 2000, and Semiconductor Index are all sitting right on or testing their 50-day moving averages. In the short term, the Stochk RSI is now showing an extreme negative conviction. Looking ahead to Friday, November 14th, the short-term bias is negative. Intermediate and long-term trends remain positive only as long as the 50-day moving averages hold. Seasonality is neutral to mildly negative, with the Nasdaq historically weaker for November 14th. The economic data calendar is uncertain. PPI and retail sales are scheduled to be released, but reports may be delayed or missing entirely due to the recent government shutdown and the subsequent backlog. In conclusion, Thursday was more than just continued growth to value rotation. It was a genuine risk-off day with higher volume conviction. The S&P 500 is now testing major intermediate-term support, while sentiment has swung decidedly negative. Longer-term uptrends still remain intact, but the burden of proof has clearly shifted to the bulls. What we'll be watching for very closely is to see if this remains a sharp but digestible pullback or the beginning of a more serious technical deterioration. Thank you very much, and I will talk to you in the next podcast.